Okay, let's bring in DoubleLine Deputy Chief Investment Officer Sherman. Jeff, it's good to have you back. How do you factor in to the geopolitical risk here, which is clearly elevated?
Yeah, it is, and Happy New Year, Sarah. I think when you think about the geopolitical risk, what you really need to look at is what's going on in the markets, right? The markets have really shrugged this off, whether it's international markets or the U.S. markets at this stage. And so right now, when you talk about the heightened geopolitical risk, yeah, Treasury's caught a little bit of a bid. We saw kind of the precious metals yesterday. We're seeing a tear in some of those industrial metals as well continue right now. And I think it comes back to what you said at the top of the segment, is that it's more of a continuation of the themes that were in play at the very end of last year. And that hasn't changed just because the calendar's flipped. And even with this military operation, and who knows if there's a second wave, as you say. We don't know if there's more countries being targeted. They're saying that in jest as well. And so at this stage, I think the markets are kind of used to some of these activities, and unfortunately, we're a little bit numb to them. And thus, again, it's just kind of business as usual for right now.
Yeah, hard to calculate the economic impact of such a thing at this point.
We're talking about oil, we're talking about electricity, we're talking about that. I mean, those are just huge infrastructure builds. And so, the question is, if we're going to depress the price of oil, which potentially is one of the goals, is that profitable at roughly a $50 a barrel kind of crude oil down there? And so those are kind of things we have to think about here. And so as someone who's a bond investor, do I want to lend to that speculative activity? Probably not at this stage. But again, I understand why there is this kind of fervor around some of that rebuild activity and potential infrastructure projects there.
So you guys at DoubleLine aren't licking your chops for these Venezuelan bonds?
No. And I mean, obviously they jumped significantly there, but there's still a lot of risk there. There's still a lot of uncertainty. And, you have this kind of continuation right now of the leadership there. And, we'll see how that transitions. They're talking about elections and things. So, again, I think it's way too early to get too excited about that, especially as a debt investor.
Okay, so on Treasuries, let's talk about your excitement level there, because last year actually was a pretty good year, all in all, where we saw a nice bond rally. Do you expect that this year too?
Yeah, I mean, look, the 10-year Treasury was one of the better performing parts of the curve last year. It still had the laggard out there being the back end of the curve, which we continue to still want to underweight this year. We think there's still risks there from the fiscal side, some of the inflationary pressures. But, as Carl said, having about a 4.20 10-year today, that's kind of top end of the range we've seen since the Fed started cutting back in September. And it's been eerily quiet in the Treasury market for the last 4 months with, all the talk about Fed independence. Dudley's out with an article today, an op-ed piece in Bloomberg about it. There's a lot of risk out there, but the Treasury market has just kind of been muddling along. And I think what this means is that the market has really kind of found that maybe we are somewhat close to this neutral rate, and we're looking for a breakout in activity. That breakout will either come through inflationary pressures. We know with some of the tax policy through the One Big Beautiful Bill, there's going to be large tax receipts in the next couple of months. That could create some spending pressure and some inflationary pressures. And then we still have all this uncertainty about the labor market. And so I think a lot of the bond market kind of levels are really contingent on what we see happening in the jobs report this Friday.
Yeah, you think it's going to be inflationary? I guess there's a view in the market, if you look at inflation expectations, that the extra, and I mentioned some of the numbers in terms of revisions on GDP and just how much the new tax legislation is going to add to consumer spending via tax refunds and that sort of thing. But the market doesn't see it as inflationary. I mean, maybe people are just going to spend it on staples and health insurance.
Well, maybe that's true. I mean, one thing, it's not just health insurance, car insurance, house insurance. Insurance seems to be a big bill these days.
Yeah, that's what I mean.
But I think I mean, look, and, maybe there's pay down to some of the credit cards or the spending that took place. We don't know what happens to when people get these rebates and checks. But, I think what you've seen in the inflation expectations, they've collapsed in the last couple of months. And some of that actually has to do with some of the oil prices as well. And so some of that is commodity related. Yes, some of that is housing market related, but that's really the Fed's measure of inflation that's driving that number down right now. And if you get that spending component out there, which is what the markets want, but especially like the equity markets, and you think about the kind of those risk on trades, then it should put a little bit of inflationary pressure there. So we don't think we're out of the woods yet. We still think you're going to see some three handle level inflation prints in 2026. And so I think it's too early to sit here and say that everything is smooth. And remember, we have missing data from a couple of months in a lot of this government data. So how's the reliability? We need a couple months of data to bring that stability back, to go back to our traditional collection methodology. So as I said, we're just kind of on that fence that there's pressures both directions. And, kind of like a 4.20 10-year kind of makes sense. If we're running about a 3% inflation, that gives us about 100 to 125 real over inflation. And, that's a pretty decent kind of risk premium in today's market.
If we do break 420, though, Jeffrey, does that mean we go straight to 4.5? What happens in the case of a breakout?
Yeah, at a breakout, you could easily see 4.5. I'm a buyer at 4.5. We've been a little underweight duration for the last 4 or 5 months. To me, that's a really good level to kind of put that on, because again, that gives us more like 150-ish real. And if you're right about the inflation coming down, maybe that's a 2% real yield, which is very attractive in today's market, especially when we talk about kind of these valuations being rich in some of the credit sectors and the equity markets as well. So to me, that stable, kind of that ability to generate that with what I think is something that could bring a stability and ballast to your portfolio, I think is very important as we talk about some of these elevated risk in the market today. And one last thing about this is that we saw this geopolitical risk take place this week, and treasuries actually did rally a little bit, right? I mean, it's not something to hang your hat on. There was this huge move, but it wasn't rejected during that. So sorry for cutting you off.
No, I just wanted to, in the time we have left, find out if you guys have any big bet in the currency market, and whether you think dollar direction will be a key determinant of where everybody else goes this year. Last year, we saw a pretty sharp decline.
Yeah, we still think the dollar has that kind of medium-term decline. We like making that bet in the emerging market space today. We started putting that on in the middle of last year. We continue to favor emerging market local currency bonds and those currency exposures there over the developed market world, because again, some of those big moves in the dollar in the developed world we think have transpired. You kind of need this convergence of interest rates in the developed world to really put any more pressure downward on the dollar there. But we still think the emerging markets have time to run. And by the way, by buying emerging markets and local currency in those areas, they also offer you a higher yield. So you actually get paid to take that trade versus giving up yield, versus if I go to like Europe, I give up yield if I want to own the euro versus Treasury. So from a bond investor and that kind of yield perspective, although the emerging markets do present a higher risk, we like the reward to risk opportunity in that space significantly greater.
I mean, they've been less risky than they have in the past, emerging markets. Jeff Sherman, we'll leave it there. Thank you.
All right, thanks for having me.